Need to unmute myself. I trust you are all well and that you've had a fantastic morning so far. Presently, just as we get started, I'm interested in seeing if I can get a short into euro versus the dollar. The price action that we've had so far, had a couple of traders in the Wednesdays at the market show, and we were talking about how the market might possibly set up from the open of the UK markets. We didn't get the setup during the opening of the UK markets. There was the open of the UK markets with a bull breakout, and we couldn't find an entry into one of our strategies, which is either first, second, or third candle trade. Nested wedge pattern, so nothing for us to trade in this particular area at the open. And then we waited to see if we get a breakout and a pullback, which is our fourth strategy. And again, that did not materialize for us. So for those traders who were watching that, we spoke about this and said, if we get back to test this level and we get a decent enough reversal candle, and I think I used this candle as an example of the kind of candle that we want. So this candle just before this huge bull breakout. If we had gotten that kind of candle here, then market would have been ripe for us to jump in and buy a double bottom and see how far we got. But we didn't get that. You don't want to buy a double bottom above bull candles. That's definitely something that you don't want to do. So nothing set up for us so far. But what we had instead was this wedge top here. And I'll talk a little bit more about this wedge top and its implications for us. And I will show you an earlier strategy that we took on the Hang Seng 50. Good opportunities that we took and managed to bank some good profits off that market. But there again, a wedge formed, and that enabled us by the way it was structured to jump into the market and sell off. Now, when you see a wedge top like this after a strong bull move up, you need to see a distinct breakout by the bears to close beneath the moving averages. So from the wedge top, bit of a pause by the bears, follow through. So this is decent enough as confirmation of bearish price action at that stage. But then what you want to see is a lower high. So coming off here, we didn't want to see a trading range. We would have wanted to see a lower high, market coming up and creating a lower high with double top anywhere within there. And from that, we would have been very happy to take that trade. Instead, what we got was a trading range pullback, tight trading range pullback. And when you saw that, so you might ask the question, hey, hang on, why didn't you take that trade? After seeing that trade set up, why didn't you jump into that? Well, we are in a tight trading range. This bull candle is a failed breakout above the tight trading range. Every time we see a trading range, or tight trading range, you can expect a breakout to fail. Most breakouts fail. So that breakout is likely to fail. And we had an outside candle, which is also a form of a trading range. When you see an outside candle back into a tight trading range, you can still expect any breakout to fail. So No setup for us here. Double bottom, but even with that double bottom is now set up for us to consider buying going long. So I'm still bearish in this market, but I'm only going to be interested if we get back into this area here and create a double top or lower high. There's no ways I'm going to be selling this low out of the trading range into a level of support. Now, let's talk about that level of support for just a few seconds. I have seen if it would highlight, but it's not highlight. Anyway, there you go. That level, just having a look at the guys on YouTube can see that that level is a big round number. It's 1. Okay. 1 is just parity when we are talking of price action. It means these currencies, in terms of the ones we're looking at, euro versus the dollar, that they are the same. 1 euro is equal to 1 US dollar. And whenever you get to parity, you can expect there to be some significant price action because it has implications on both economies. At this level, we are saying it really doesn't matter whether you stay in the US or stay in Europe or you trade US dollars or keep your money in euros. It's all the same. These huge economies, the Eurozone and the US economy, are exactly the same in terms of value as reflected in the currency. Now that's a pretty big deal for the financial markets, a pretty big deal for investors, for consumers, etc. So no one can say, hey, US is stronger than the Eurozone, or the Eurozone is stronger than the US. It is parity, it's all the same, it's like 1. Hence, that level is a key level for us to watch. So if you get a bear setup, you don't want to sell down here, hoping to break through parity and the market continues to sell down. Because at this level, trust me, there is going to be bulls. Why do I say that? Because the bulls want to keep the price above parity. You know, the bulls want the euro to keep going up and up and up and up. Okay, so that all of a sudden, instead of 1-to-1, your euro gets you 1.2, 1.4, I don't know, 2-to-1 US dollars. But everyone else who doesn't want that to happen, they want to keep selling and selling and selling and selling and selling, you know, and get to 99 cents, 54 cents, 50 cents, whatever. Just keep weakening and cheapening this market. So we have to absolutely make sure that the setups that we take are as pristine as possible. So we didn't get the lower. If you'd taken that lower high, for whatever reason, which you should never do, you can't sell in the middle of a trading range. But if you'd taken it, when your stop still has to be up there, and when you see that, you ought to be coming out. But that is not a trade that you would take. It's not set up properly. It is a lower high, fantastic. So I am waiting. I am eagerly waiting to short the euro, but I'm not shorting anywhere in here. I'm not shorting anywhere down here. So even if the market keeps selling off and breaks beneath parity, it's big round number 1,000, I'm still not going to sell because the bears would have another problem, which is the high of yesterday. That's a level of support. That's a level of support. This huge, this bull breakout can still be defended. The bulls could just say, well, if we can't create a double bottom here, let us wait and create a double bottom here. So you don't want to be selling there. However, because there is trading range price action is broken when the market breaks beneath the 10 EMA, we have broken the trend. So we are in a trading range, but if you get up to the top here, and that is my area of interest. Oops. If we get up to the top here, that's where I would definitely sell. And then I'll just use measured moves to decide where to jump in and put in my stop. So looking short and just waiting for the right opportunity. Where would you, if I jump in, where would I put the stop? Well, earlier on we spoke, the traders I was with during the Wednesdays at the market show, we said there's a bull breakout, there's the first pullback when this low was taken. The measured move of that is here. That is where the bulls would like to take the market. It can happen in just one huge bull candle. You can get up there. We've seen those before, a couple, to test that, and then the market turns. We also have this wedge top, the height of the wedge from this high to that high to here. The measured move break above that is just about there. So there's levels of resistance here. So if you are taking any trade anywhere here, even if you decide, okay, George, I'm just going to take this trade, I think it can go down. It can go down the whole day. You don't put your stop here. That's not the correct technical place, okay, because the market isn't broken up in this low. You don't put your stop here. You're in a trading range. Your stop has to come up here, which would mean if you decide just to take that, at the very least, it's a 40 pip stop, but the correct place because of the measured moves is a 60 pip stop. So if you're going to put a 60 pip stop in the market, then it really is better because that's the level where you want to put your stop. That's the correct level. Then the wisest thing to do is wait for the higher probability event of the market pulling back and coming back and giving you a lower high double top somewhere within here. And if you do get that, you still put your stop there, but now it's like a 30 pip stop. Then if the market gets back down here and starts to accelerate down, you have opportunities. So that's kind of what I'm looking at. Okay. Another way to look at it, if you looked at this and said, hang on a second, there's something interesting here. The market went up, this whole bull thing, and it pulled back to that level. I don't know if you can see that. Let's see. There's the low. Okay, there's the low. So the breakout point above the high of yesterday. So the market from breaking out above the open of yesterday with the huge bull candle. The pullback was into the Asian session of today. Where is the expected measured move? Okay, there is the expected measured move. So if you looked at it that way, although we've got a huge bull trend up here, these bulls are at a stage where they'd built positions that will be taking profits at that level. And what you can do, you can just go down to go up to the daily. Okay, so in this area, we also have that potential measured move that we showed from yesterday. But if you go to the daily is interesting. This channel line here that the bulls broke out above is a long-term bear channel. So if we do that, this has been going on for virtually the whole year. From the beginning, from February, the market has been in a persistent bear channel. Tried to break out above here, came back in, tight trading range, test of it, kept on selling. Tight trading range, bulls tried to break out, came back into the channel, tried again here, came back, double top beginning of October, and we stayed in the channel until yesterday when we had the breakout above the channel. Now, this breakout above the channel was preceded. So for the guys who keep talking about price action, you hear me say, whenever you're looking at any day, look at the last three candles, the last 3 day candles of the last 3 days. We said, oh, fantastic, good for the bulls, good candle yesterday, but doesn't mean I'm just going to go and buy it. If I look back, the bulls broke out above a 1 bar doji, which is a trading range. And when you see a 1 bar doji, you can expect that its measured moves, market could fail. So the measured move of that 1 bar doji is within that zone. So there's no point cluttering your charts because that zone is a zone that's got the one. The price at 1.0000 parity. So that 1 bar doji was just setting up to get there. So you can expect a bit of failure there. There's another channel that you ought to draw into the market. From that high in August, you connect to that high in September, the channel line comes here. So yesterday we tested this, and today we're breaking above it. So this is good for the bulls. If the bulls are able to keep the day and close above here and do a follow-through candle, then we can start to say, hey, the bulls have changed the structure of the market because they've broken out, confirmed breakout above this bear channel, confirmed breakout above this bear trend line from August, confirmed breakout above the parity price 1.00. If they close above here and put a follow-through candle, then it's a different structure. But as it is now, probabilities still favor the bears, okay, because of this level of resistance, this strong lower high double top. They're trying to break out this bear channel trend line. Probability still favors the bears until we have a strong confirmed breakout. So if we go back to the 5 minutes, I'm still biased towards shorts for the euro, but it has to set up for me in the correct place. That's where the correct place is going to be. And we still have plenty of time in the day. We're only coming up to 4 hours from the open of the UK market, so we're halfway through their particular day, but we still have the whole US session to come up, so there's no rush. Let's wait to see if we get there and get our reversal set up. Now, while we wait for that, let's have a quick look. I'm not talking about Hang Seng 50. But let's have a look at UK 100. So earlier on, when we were looking at UK 100, we were again hoping for a lower high after this particular setup. But that became the trigger for the sell-off. But we didn't jump into that because I was selling into the middle of a trading range. Had the market given us a lower high somewhere here, would have been perfect for us to jump into the trade. A little caveat about UK 100. If you go to the daily, just have a look at that daily chart. The same kind of thinking process that we kind of have as price action traders, at least 5 minutes is the way I recommend to guys to get your context right. We trade in this day, look at the last 3 candles. Doji candle, perfect doji candle, huge tail at the bottom. Inside candle to another perfect doji candle. Doji candles are trading range price action. trading range price action is indecision in the marketplace. Market is going to decide which way to go. Opened here, sold off, and there was disagreement, and market bought back again. That's the area of agreement. Same thing took place here. So while any inside pattern is a breakout mode, but when you have trading range candles like this, you can expect that a higher probability event, plus 90%, is that any breakout above the high of a low of yesterday or above the high or low of this doji candle, it's going to fail. I mean, if you just look at that particular doji candle, the measured move of it is going to be somewhere up here. And what we have up here is the beginning of this bear breakout. Let me do it this way. I'm going to keep it on the chart. So this was the 23rd of September. This is the high of 23 September. Breakout. So I'm just going to keep that on the chart. Oh, where did I put it? I put it on the 5 minutes. So it should not be on the 5 minutes. I want the visualization on all time frames. Okay, so that bear breakout broke out of the September trading range, huge bear breakout on the 23rd of September. So a measured move above this 1 bar trading range is likely to take us to test that level. So if we just did a measured move of the height of this 1 bar doji right here, the bulls would only get there and the bears would defend that breakout level. So that, and we look at the bear breakout point, that point, so there's the high of the bear breakout. That day broke out beneath the low of August, so that's why we have this as the bear breakout point, 23rd September. So that gold line represents the breakout level. So the bears are going to defend this level. They will defend the breakout point. They will defend the high of their breakout candle. So you can expect any breakout to fail. It can fail here at this lower high, double top, or it can fail here or fail there. Now, this is your longer term time frame on the daily. The reverse of that is also the same, inverse of it. If the bears break out beneath here, the bulls are going to defend. They're going to defend this level, which was the measured move that the bears created. When the market turned, they're going to defend present low of 2022. They're going to defend all of these lows. So if we break out beneath this 1 bar doji, the bulls are going to be coming to defend there. So that kind of gives you a higher time frame view of what's taking place. And what that means for us on the 5 minute, when we see this, we can see the greater opportunities for us. So whatever trading range price action we get, we must expect failed breakouts at the end of the previous highs. And if we see the failed breakout pattern, we must just trade it back into the range. So right now, as you saw on the daily, we're back at the open. It's almost a perfect doji so far. You know, trading range behavior, you want to sell quite high up in the trading range. And you could ask, well, what about the buying? So at that point, that was today's low. Today's low is now a little bit lower. Okay? So this candle is today's low. So if you want to buy, you're going to have to wait to see if you get a double bottom here. Okay. When we were here, let's go back. That was the low of the day. It was the low of the Asian markets. So when we're here, we're looking for a possibility of a double bottom. We didn't get it. But instead, we got a failed breakout beneath that low. The market has come back into the trading range. So the bulls are defending that level. So that low of the day becomes of interest. If we get a double bottom here, we wait for a high low and we trade. If we don't get anything, let's just wait. This is trading range price action. It's not trend. The market is not in trends yet. So we wait, we buy at the bottom, high low. We sell at the top. So if we get up here at any time, next few candles could be 1, 2, 3 big candles that do that. And we get a reversal, then we must look to sell. Quick look at S&P 500. So S&P 500, I look at it during the day, but I'm actively interested in it by the time we start to get to the open of the US market, which is coming up in a couple of hours. And at this stage, I can see this gold line and marked it as a gap down level. That's where the market gap down. Wedge top to get there, tight trading range to get there. So bears are defending the gap down level because it is the bears that created the gap down. So the bears are presently defending that. So if the market comes back up here and creates a double top somewhere within here, that level or the previous US level, this level creates a double top, entering into the open of the US markets, then I'm happy to trade the US session open, looking for ways to go short. Now, if you just have a look to the left, so we gap down from here. What is that gap down all about? So that gap down was simply the bears selling off within the last hour or so of the US markets. Bears sold off, pulled back, and that gap down was a continuation of that selling. How do you know that? You could use a measured move tool. If you call that the first leg of the sell-off. So there is the first leg up to where that candle ended. And there is a pullback. Let's just do that. So I am starting the first leg there, that high. And I'm ending that first leg at that low. So that was an hour to go before the market closed. Whatever that caused that, whether it's just bear sell-off at the end of the day or some announcement, the bears that created this after a pullback want to get to a measured move. And you can see that bear breakout ended here, where we've got that low, and the pullback started there. Well, pullback was that. The second leg started there. But then the market closed. So when the market gapped down, it was just a completion of this whole move here. So these bears got to their measured move within the open. That's probably one of the good uses of looking to what happened in the US session. Okay, then wedge bottom. So right now, my interest with this market is see what happened with the terminal open. So what's a possible scenario if the bulls start to buy aggressively and they break out above this high? Where would be the next area of interest? Well, it would be a measured move again. So if we have strong bulls coming into the market, breaking out above this high, the measured move is up here. And what that tells me is if I see a setup here in the lower high, I have to be comfortable to put a stop of at least $22. And that's my maximum stop that I'm prepared to put on S&P 500 is $20. So that stop will be too wide for me. I'd rather get a little bit more to take that. But if you get a double top and a lower high, then I don't have to put a stop up here. My stop can be a little bit tighter, which would allow me to take this trade comfortably. So I'll keep looking at that market and seeing what we get. Just want to see if there are any questions. Okay, no questions. No, let me start. Let's have a quick look at Euro one more time before we. Okay, Euro is interesting. It is taken away to an area of interest in terms of possibly selling off this market. We're only interested in a double top, lower high in this particular area. So we don't know where it's going to set up or how it's going to set up. But I'm interested in shorting. But I only short when the market gets to where I want to short. Otherwise, I'll just sit and watch and let it go. So you can see the bulls are breaking out just above potential trend line. But that's not our interest. Our interest is that lower high. There's another dip at the nearest one in that. Our interest is to see how we break out above that. So if there was a market that I might continue to watch consistently for the rest of the day, it's going to be the euro. That's what I'm going to watch. Because if the bears are strong and they can create a lower high, so if you watch that, the bulls try to get above it, we must see some form of a failure. Bears trying to change structure. And if we then get above that, we want to see bears again forcing the market to fail. And we might get a wedge top, one that high, maybe another one. If you get a wedge top, so this kind of pattern, if we were to get a wedge top, just to illustrate possibility, or rather what would really be exciting in terms of taking the trade. There's one market going up once. If the market came up again here, so maybe let's just It's interesting when I was talking to traders earlier on, pointed out some scenarios on Hang 50, which really came out the way that we kind of thought we were doing so, and gave us the opportunity to jump in and take trades. So if you're going to be watching this market, anywhere within this kind of zone is where I'm going to be looking. If market goes up here and turns and comes up, that should be a wedge top 1, 2, 3. A wedge top at a lower high double top. After a wedge top is a powerful sell pattern. You just wait, look at your candle, strong bear candle, sell beneath it. And if that sets up, you really can expect the high probability of the market selling off. Who knows how far, maybe just back to the open of the day. Okay. So the market can do that. So that's my kind of thinking around that. Now, just very quickly, have a look at Hang Seng 50. So I spoke about this with the traders who were in from the Wednesdays market, the guys who come to Wednesdays at the market, private subscription, third and fourth Wednesdays, and we traded through all of this and were rewarded with some fairly good trades. First thing with a converging triangle, which is a breakout mode pattern. And say the order was here, and the stop of it was above nearest technical point, which was here. Triggered into the trade, stopped out first candle. Absolutely brilliant. Nothing wrong with the strategy, just one of those probabilities. It stopped out. And then we didn't get first, second, third, and fourth candles. We don't buy above breakout candles. After a bear pattern, we have to wait. And we couldn't see any other way to get in. Nothing pulled back to the EMAs for us to jump in. Instead, what we had another repeat of the pattern. Okay. This was a bear pattern, inside pattern. Now we have a bull pattern, inside. But these are converging triangles. Converging triangles is a breakout mode. When you see it, you expect there to be a breakout in the direction of the trade and a possible pullback which you can trade. So when we saw that, the higher probability event, 60–70% of the time, is that you have a bear breakout. You can jump in, you get a pullback to test that level and acceleration down. But we got the lower probability event that stopped out. So when we saw that, same pattern, breakout, failed breakout with a bear channel line. So failed breakout, also go to the measured move of that first pattern, or that breakout candle. Measured move, failed breakout. So at this point, I was talking to traders that the bears are not strong. I mean, the bulls are not strong. If the bulls were strong, they would not have allowed a breakout mode pattern to set up here, because no breakout likely to fail. They would have just carried on strong bull candles, maybe one bar pullback and accelerated up. So that started to give us indications that the market might fail, that the bulls might fail. That candle was a failed breakout, confirmation of a failed breakout, the bear candle. And now you start to think, well, if I get a decent enough reversal, on strategy number 4, a double top of sorts, I can trade. That was an inside candle, inside candle. And when you see an inside candle, you can expect a breakout to fail. Sure enough, with a breakout, and it failed. So that's a trade that you could have taken, and you would have put your stop at the measured move. Or you wait and say, well, let me see what else I get. I get a wedge top, like we had forming on the euro, a wedge top. You could still take that trade, but you're looking for a huge stop up there. Or you wait and which is what I'd recommend for intermediate traders. Wait to see, okay, there is the wedge top, fantastic. If I see a wedge top, I want to see bear strength, pull back in the lower high. And this is what I'm kind of talking about. That trade you should have taken. You know, as an advanced trader, I took an earlier trade, which is absolutely fantastic. So I know how to manage it. But all intermediate traders, especially guys who've just been through the course, that's a classic trade you can take. After this bull strength, we have a wedge top, we have a break of the trend line, we have a double top, perfect double top, go in a lower high, you take that trade. If you didn't take that trade, you can take that trade beneath that and wait for the acceleration. Another pattern setup here, but this is a pattern which I haven't spoken about. I explained to the guys earlier on to one of our advanced strategies. Low test, high test, in the right context, coming off a double top. You can sell that. So I sold that trade, and the goal was to get to a measured move of that trading range. We got to the measured move and able to exit trades here, or you could have exited anywhere within here. And that was the regards to the open of the UK markets. Now, the thing about this market, you see these vertical lines. You really have to be very careful with this market because it opens and then it closes for an hour at 12 noon Singapore time, opens after an hour, but then they break again, they close again at 10:30, which is what, 4:30 p.m. the market closes again. So if you're not in any trades, you've got to treat each close as red news announcements. Okay. Today was great because market kept on selling off and opened yet sold off. But many times you'll see gaps. After the morning session, the first session, market can gap up and then sell off. So if you're in trades, you have been stopped out, or gap down and do a trading range. Here could have been a gap up or a gap down. So we didn't take any further trades as a setup because we're going into the close of that particular session. Now that was stopped up here, 0.25%. Remember, we always have the 0.25%. As the market turned, plus or minus 1.5% gain, less the 0.25%. So net plus 1 or so percent. So good return so far for the market not open. And that's really what we've traded so far. And now we are waiting for the euro. So it'll be interesting to talk about this sometime next week and see if we get set up of that. But also, I'm doing a little video for the Trader Talk Radio on Sunday. If this market sets up nicely and we reverse out, I'll probably talk a little bit about what will happen if we sell off. But until then, we're just going to have to wait and see what the market presents us. So finally, just quick look again, S&P 500. Let's wait to see if we get a double top at the open of the US markets. UK 100, nothing for us to do. Either double bottom here, higher low, trading range, that's fine. And then get to the top, double top, wedge top, and we sell off back into the range. So huge opportunities coming, but we just need to wait. 150, we are in a tight trading range. There's nothing much for us to do in this market. The only way I'm going to be interested if we get back and try to test the high of yesterday without actually breaking out above it and can sell off, or if we get back to test the low of today, double bottom, etc. Otherwise, I probably think this market, well, might be done for the day. But that's where there could be another catalyst that kicks it in. So, guys, thank you very much. We will catch up with you next week. Bye-bye. Alon, thank you very much, sir. Bye-bye.